What if I told you that everything you've been taught about investing is not just wrong, but dangerously misleading? What if the sophisticated theories taught in every business school, the complex mathematical models used by Wall Street professionals, and the diversification strategies preached by financial advisors are actually designed to make you poorer, not richer? Today, we're diving deep into Warren Buffett's revolutionary critique of modern finance theory and exploring why the Oracle of Omaha believes that throwing darts at a stock table might actually be better than following conventional Wall Street wisdom. This isn't just contrarian thinking for the sake of being different. This is about understanding why Buffett has generated 20% annual returns for over 4 decades while the so-called experts have been teaching theories that led to multiple market crashes. By the end of this video, you'll understand why Buffett jokes that his followers should endow professorships to keep teaching efficient market theory, why he compares active traders to people who engage in one-night stands, and most importantly, how you can apply his time-tested principles to build real wealth in the stock market. Let's start with a story that will shock you. For the past 35 years, the most influential ideas in investing haven't come from successful investors, but from academics in ivory towers who created something called modern finance theory. This elaborate set of mathematical models and sophisticated-sounding concepts all boil down to one simple, devastating conclusion: it's completely pointless to study individual companies or investment opportunities. According to these theories, you might as well close your eyes and throw darts at the stock pages of the newspaper. The theory claims you'll do just as well, if not better, than someone who spends years studying businesses, analyzing financial statements, and understanding competitive advantages. The cornerstone of this thinking is modern portfolio theory, which took the old folk wisdom of "don't put all your eggs in one basket" and wrapped it in complex mathematical formulas. The theory suggests that you can eliminate all the specific risks of individual companies by holding a diversified portfolio. What's left over is something called systematic risk, measured by a number called beta. Beta became the holy grail of risk measurement. It's a simple number that tells you how volatile a stock is compared to the overall market. A beta of 1 means the stock moves exactly with the market. A beta of 2 means it's twice as volatile. Wall Street fell in love with beta because it seemed so precise, so scientific, so much more sophisticated than the old-fashioned approach of actually understanding what a company does. But here's where it gets really interesting. This wasn't just academic theory confined to universities. These ideas spread like wildfire through Wall Street, Main Street, and every financial institution in America. Professionals began believing that stock prices always accurately reflect fundamental values, that volatility is the only risk that matters, and that the best way to invest is to build a diversified portfolio based on mathematical models. The theory seemed unshakable until reality came crashing down. The stock market crash of October 1987 was partially caused by something called portfolio insurance, a computerized technique based on modern finance theory that was supposed to protect investors. Instead, it amplified the crash. Then came the market break of 1989, followed by phenomena that modern finance theory simply couldn't explain: the outperformance of small-cap stocks, high dividend yield stocks, and low price-to-earnings ratio stocks. But the final nail in the coffin was the technology and internet bubble of the late 1990s and early 2000s. Stock prices gyrated wildly between euphoria and despair with no connection whatsoever to actual business value. Pets.com was worth billions one day and bankrupt the next. Companies with no revenue were valued higher than profitable businesses that had been around for decades. Suddenly, growing numbers of investors started questioning whether beta really measured investment risk and whether markets were actually efficient enough to make these theories meaningful. And that's when people started paying attention to someone who had been quietly proving these theories wrong for decades: Warren Buffett. Warren Buffett represents what academics call an anomaly in their theories. For more than 40 years, he has generated average annual returns of 20% or better, essentially doubling the market average. But here's what makes it even more remarkable: his mentor Ben Graham had done the same thing for 20 years before Buffett even started. This wasn't luck, and it wasn't a small sample size. We're talking about 60 years of combined outperformance across different market conditions, economic cycles, and decades. The sample sizes were significant, the time periods were extensive, and the results weren't skewed by a few fortunate experiences. No data mining was involved, and the performances were longitudinal, not selected by hindsight. Yet when faced with this mountain of evidence, what did the devotees of modern finance theory do? They came up with increasingly desperate explanations. Maybe Buffett was just lucky, they said. Maybe he was the equivalent of a monkey who randomly typed out the complete works of Shakespeare. Maybe he had access to inside information that other investors didn't have. These explanations reveal something profound about human psychology and institutional thinking. When confronted with evidence that contradicts deeply held beliefs, people don't abandon those beliefs. Instead, they create elaborate explanations to dismiss the evidence. The academic and financial establishment had too much invested in modern finance theory to admit it might be fundamentally flawed. But Buffett had a response that was both humorous and insightful. He suggested that devotees of his investment philosophy should probably endow professorships at universities to ensure the perpetual teaching of efficient market theory. Why? Because if everyone believes markets are perfectly efficient and that individual stock analysis is worthless, it creates more opportunities for those who actually understand how to value businesses. Think about it this way. If you're competing in a game where most of your opponents have been taught that skill doesn't matter and that random chance determines outcomes, you have an enormous advantage if you actually know how to play the game well. Buffett's success isn't despite efficient market theory, it's because of the opportunities that theory creates by discouraging serious business analysis. The advice Buffett gives to most investors is simple: ignore modern finance theory and stick to what he calls investment knitting. For many people, this means long-term investment in a low-cost index fund. For those willing to put in the work, it means conducting hard-headed analyses of businesses within their circle of competence. But here's the crucial difference. In Buffett's world, risk isn't beta or volatility. Risk is the possibility of permanent loss of capital or inadequate returns relative to inflation and opportunity cost. This completely changes how you think about investing. Let me explain why Buffett thinks beta is not just useless, but actively harmful to investment thinking. Beta measures how much a stock's price moves relative to the overall market. According to modern finance theory, a stock that moves more than the market is riskier than one that moves less. But Buffett points out an absurd consequence of this thinking. A stock that has dropped very sharply compared to the market becomes riskier at the lower price than it was at the higher price. Think about how backwards this is. If you're buying a business, and the price drops significantly while the underlying business remains the same, you're getting a better deal, not a riskier one. Imagine you're buying a house. You find a house worth $300,000, but the seller is asking $350,000. You walk away because it's overpriced. A month later, the seller drops the price to $250,000. According to beta logic, this house has now become riskier because its price has become more volatile relative to the housing market. This is obviously nonsense, but it's exactly how beta measures risk in stocks. The problems with beta go even deeper. Beta cannot distinguish between the risk inherent in a single-product toy company selling pet rocks or hula hoops versus another toy company whose sole product is Monopoly or Barbie. Both might have the same beta, but any reasonable investor can see that one business is built on a fad while the other has enduring value. Beta also fails to account for business fundamentals. A company with strong management, dominant market position, predictable cash flows, and little debt might have a high beta simply because its stock price is volatile. Meanwhile, a company with terrible management, declining market share, unpredictable earnings, and crushing debt might have a low beta because its stock price moves slowly. This is why Buffett emphasizes that assessing real investment risk requires thinking about a company's management quality, products, competitive position, and debt levels. The inquiry should be whether after-tax returns on an investment will at least equal the purchasing power of the initial investment plus a fair rate of return. The primary factors that matter are the long-term economic characteristics of a business, the quality and integrity of its management, and future levels of taxation and inflation. These factors might seem vague compared to the apparent precision of beta, but judgments about these matters cannot be avoided without significant disadvantage to investors. Buffett's critique of beta reflects a fundamental principle he learned from Ben Graham: it is better to be approximately right than precisely wrong. Beta gives investors a false sense of precision while completely missing the factors that actually determine investment success. Modern finance theory's prescription for managing risk is diversification. The idea is simple: spread your investments across many different stocks, sectors, and asset classes to reduce risk. This sounds reasonable on the surface, but Buffett argues that diversification can actually increase risk rather than reduce it. The problem with diversification is that it often leads to what Buffett calls diworsification. When you spread your investments too thin, you're forced to include investments you don't understand, companies you haven't researched thoroughly, and businesses with mediocre prospects. You might reduce the volatility of your portfolio, but you're also reducing your potential returns and increasing the risk of permanent capital loss. Buffett's approach is the opposite of conventional diversification. He believes in concentration, both of portfolio and mind. He often quotes John Maynard Keynes, who was not only a brilliant economist but also a successful investor. Keynes believed that an investor should put fairly large sums into 2 or 3 businesses he knows something about and whose management he trusts. This approach might seem riskier from a modern finance theory perspective, but Buffett argues it actually reduces risk. When you concentrate your investments, you're forced to think more intensely about each business. You can't rely on diversification to protect you from bad decisions, so you become more careful about the decisions you make. Concentration also means you only invest when you're truly comfortable with a business's fundamental characteristics. You can't just buy a stock because it fits your asset allocation model or because it has the right beta. You have to understand the business well enough to be confident in its long-term prospects. Buffett illustrates this with Mark Twain's advice from Pudd'nhead Wilson: put all your eggs in one basket, and watch that basket. This is the complete opposite of conventional diversification wisdom, but it reflects a different philosophy about risk and return. The costs of excessive diversification go beyond just mediocre returns. When you constantly buy and sell stocks to maintain your desired diversification, you incur massive transaction costs. Buffett estimates that these frictional costs, spreads, fees, commissions, and taxes, can consume 20% or more of total corporate earnings in the economy. Buffett jokes that calling someone who trades actively in the market an investor is like calling someone who repeatedly engages in one-night stands of romantic. The constant reshuffling of portfolios destroys value through transaction costs and prevents investors from benefiting from the long-term compounding of business value. This is why Buffett advocates for what he calls investment knitting, finding a few businesses you understand, buying them at reasonable prices, and holding them for long periods. This approach eliminates most transaction costs and allows you to benefit from the compounding of business value over time. To understand Buffett's investment philosophy, you need to understand the foundation he learned from his mentor Ben Graham. Graham introduced 2 concepts that revolutionized how intelligent investors think about markets: Mr. Market and the margin of safety. Mr. Market is one of the most brilliant metaphors in investment history. Imagine you own a business in partnership with someone named Mr. Market. Every day, Mr. Market comes to you with an offer to either buy your share of the business or sell you his share at whatever price he's decided on that day. The key insight is that Mr. Market is emotionally unstable. He's prone to manic swings from extreme optimism to deep pessimism. Some days he's so excited about the business prospects that he offers to buy your share at a ridiculously high price. Other days he's so depressed that he's willing to sell his share for far less than it's worth. The beauty of this metaphor is that it separates price from value. The price is what Mr. Market is willing to pay on any given day. The value is what the business is actually worth based on its ability to generate profits over time. These 2 things are rarely the same, but most investors never notice the difference. Graham's genius was recognizing that the more unstable Mr. Market is, the more opportunities he creates. When he's manic and offering high prices, you can sell to him. When he's depressed and offering low prices, you can buy from him. The key is to never let Mr. Market's emotions influence your own assessment of what the business is worth. This leads directly to Graham's second crucial concept, the margin of safety. This principle holds that you should never make an investment unless there's a substantial difference between the price you're paying and the value you're getting. The margin of safety protects you from errors in judgment, unforeseen circumstances, and the general uncertainty of the future. Buffett has said that if Graham were forced to distill the secret of sound investment into 3 words, they would be margin of safety. After more than 40 years of investing, Buffett still believes these are the right 3 words. The margin of safety principle also reveals why the term value investing is redundant. All true investing must be based on comparing price to value. Strategies that don't employ this comparison aren't investing at all. They're speculation based on the hope that prices will rise rather than the conviction that you're buying something for less than it's worth. Many professionals make the mistake of distinguishing between growth investing and value investing, but Buffett argues that growth and value aren't separate concepts. Growth is simply a component of value. A company that's growing its earnings rapidly might be worth more than a company that isn't growing, but you still need to compare the price you're paying to the value you're getting. This framework completely changes how you think about market volatility. When modern finance theorists see volatility, they see risk. When Buffett sees volatility, he sees opportunity. The more Mr. Market swings between extremes, the more chances you have to buy low and sell high. The third pillar of Graham and Buffett's investment philosophy is the circle of competence. This deceptively simple concept has profound implications for how you should approach investing. The circle of competence principle instructs investors to consider only those businesses they can understand with reasonable effort. This isn't about being an expert in every industry or understanding every nuance of a business. It's about honestly assessing what you can and cannot evaluate competently. Buffett's circle of competence includes businesses like insurance, consumer goods, and media companies. He understands the economics of these industries, the key success factors, and the competitive dynamics. He avoids businesses he doesn't understand, even if they seem to offer great opportunities. This commitment to staying within his circle of competence has enabled Buffett to avoid many of the mistakes that have plagued other investors. He famously avoided the dot-com bubble of the late 1990s, not because he knew these companies would fail, but because he couldn't understand their business models well enough to evaluate their prospects. The circle of competence also protects against what Buffett calls the institutional imperative. This is a powerful force in which institutional dynamics produce resistance to change, wasteful spending, and reflexive approval of poor strategies. The institutional imperative often interferes with rational decision-making and produces a follow-the-pack mentality. By staying within your circle of competence, you're less likely to be swayed by popular trends, technological fads, or new era rhetoric that has repeatedly led to speculative bubbles throughout history. You can focus on understanding a few businesses really well rather than trying to keep up with every new investment fad. The circle of competence also naturally leads to concentration rather than diversification. If you can only competently evaluate a limited number of businesses, you're going to end up with a more focused portfolio. This might seem riskier from a modern portfolio theory perspective, but Buffett argues it's actually safer because you're investing in businesses you understand rather than ones you don't. Expanding your circle of competence is possible, but it takes time and effort. You can't just decide to understand a new industry overnight. You need to study the business models, competitive dynamics, regulatory environment, and key success factors. Most importantly, you need to be honest about whether you truly understand these factors or whether you're just fooling yourself. The beauty of the circle of competence is that it's different for everyone. A doctor might have a natural advantage in evaluating pharmaceutical companies. A software engineer might better understand technology businesses. A retail worker might have insights into consumer behavior that help evaluate retail stocks. The key is to start with what you know and gradually expand your knowledge over time. Don't try to be an expert in everything. Focus on becoming truly competent in a few areas where you can develop sustainable advantages over other investors. One of the most dangerous aspects of modern finance is the cavalier attitude toward debt. Buffett's essays on debt, which he aptly calls Life and Debt, explain both the seductive appeal and the devastating risks of leverage in personal and corporate finance. The academic defense of high debt levels is something called the dagger thesis. This theory suggests that loading a company with debt is like mounting a dagger on a car's steering wheel. It forces management to drive more carefully because the consequences of mistakes are so severe. But Buffett points to the massive number of corporate failures during the early 1990s recession to show why this theory is fatally flawed. Companies with crushing debt burdens didn't become better managed, they became bankrupt. The supposed disciplining effect of debt was overwhelmed by the financial fragility it created. The problem with debt is that it creates what Buffett calls financial risk on top of business risk. Every business faces uncertainty about future cash flows, competitive pressures, and economic conditions. When you add debt to the equation, you're betting that the business will generate enough cash to service the debt payments under all circumstances. This bet might pay off during good times, but it can be catastrophic during downturns. A business that might survive a recession with a strong balance sheet can be forced into bankruptcy by debt payments it can't make. The supposed benefits of leverage, higher returns on equity during good times, are often wiped out by the risk of permanent capital loss during bad times. Buffett's approach to debt is simple: use as little as possible and only when the terms are extremely favorable. Berkshire Hathaway has maintained a fortress-like financial position throughout Buffett's tenure, with minimal debt and massive cash reserves. This conservative approach has allowed Berkshire to survive every financial crisis and take advantage of opportunities when others are forced to sell. The lesson for individual investors is equally important. Avoid borrowing money to buy stocks, don't use your home as collateral for investment purposes, and be extremely cautious about any form of leverage. The potential for higher returns is rarely worth the risk of permanent capital loss. Warren Buffett's investment philosophy isn't just a critique of modern finance theory, it's a practical guide for building wealth over the long term. The principles are simple to understand but difficult to implement because they require discipline, patience, and the courage to think differently from the crowd. The key insights are clear: focus on businesses you understand, buy them when they're trading below their intrinsic value, and hold them for long periods. Ignore the daily noise of market prices and focus on the long-term economics of the businesses you own. Avoid debt and maintain a margin of safety in all your investments. Most importantly, remember that investing is about buying pieces of businesses, not trading pieces of paper. When you buy a stock, you're becoming a partial owner of a real business with real assets, real customers, and real cash flows. The stock price is just Mr. Market's daily opinion about what your ownership stake is worth. This approach won't make you rich overnight, but it's the most reliable path to building wealth over decades. It's worked for Buffett for more than 50 years, and it can work for you too. The question isn't whether you can beat the market in any given year, it's whether you can compound your wealth at attractive rates over the long term while avoiding permanent capital loss. The choice is yours. You can follow the sophisticated theories that led to multiple market crashes and mediocre returns, or you can follow the simple principles that have created more wealth than any other investment approach in history. As Buffett might say, it's better to be approximately right than precisely wrong. Don't forget to like this video if you found it helpful, subscribe for more deep dives into investment wisdom, and hit the notification bell so you never miss our latest content. What do you think about Buffett's critique of modern finance theory? Let us know in the comments below.